More stocks don't mean more safety. They mean more confusion dressed up as caution. I want you to let that land for a second before we move on, because I know it cuts against almost everything you've been told about how to invest responsibly. The financial industry has spent 50 years of advertising in textbooks and well-meaning advice from well-meaning advisors, convincing you that the path to safety is through spreading. Diversify, they say. Don't put your eggs in one basket. Own a little of everything. Spread it thin enough, and nothing can really hurt you. And somewhere along the way, that advice, which started as a legitimate insight about catastrophic single position risk, morphed into something almost comedic. Portfolios of 40, 50, 60, 100 positions that nobody actually understands, nobody actually monitors with any real depth, and nobody could explain with genuine conviction at 10 o'clock on a Tuesday night when the market starts moving against them and the anxiety kicks in and all those positions suddenly start looking like strangers they let into their house. Here is what I know. After decades of thinking deeply about how people build wealth and how they destroy it without meaning to, owning things you don't understand is not protection. It is the illusion of protection. It is a story you tell yourself about safety that has very little to do with actual safety and a great deal to do with anxiety management. And the difference between those two things, the difference between real protection and the feeling of protection, is exactly where real wealth lives. And more painfully, it is exactly where real loss lives too. So today I want to talk about something that is going to sound, at first, like a reckless idea. I want to talk about owning 3 stocks. Not 30, not 100, 3. A 3-stock portfolio. And I want to make the case carefully, completely, with real emotional honesty about what this approach requires and what it demands of you, that for the self-directed investor who is willing to do the real work, 3 deeply understood positions will do more for your long-term wealth than 30 vaguely understood ones almost every single time. But before I give you the framework, before I walk you through the principles and the practice, I want to give you 2 images. 2 pictures that I hope will do something that pure logic rarely does on its own. I hope they'll reach you somewhere lower than your analytical mind, somewhere in the gut where the real investing decisions actually get made, whether we acknowledge that or not. The first image is a garden. I want you to picture 2 gardeners. They each have the same sized plot of land, let's say a quarter of an acre, the same soil, the same access to sunlight and water and tools. They're starting from the same place. The first gardener has read every gardening magazine, subscribed to every newsletter, listened to every podcast about what's growing well this season and what the experts are excited about and what the seed catalogs are calling their breakthrough varieties. And so she has planted 47 different things. 47 different species of vegetables, herbs, flowers, experimental hybrids she read about in a magazine, a few things she planted because her neighbors seemed enthusiastic about them, a few things she bought on impulse at the garden center because they were on sale and she didn't want to miss the season. Her garden is full. Her garden is busy. There is something growing in almost every square foot, and she spends most of her time managing the chaos of it. Something is always dying, something is always diseased, something is always competing with something else for the finite resources of soil and sun and water and her attention. She knows the names of everything she's planted. She knows very little about any of them at the depth required to make them truly thrive. She is busy all the time. She is harvesting mediocrity in 47 varieties. The second gardener has the same plot. She spent the first month not planting anything, just reading, just thinking, just asking herself what she truly understood, what she genuinely believed would flourish in this particular soil, what she had the knowledge and the patience and the real commitment to tend properly. And at the end of that month, she planted 3 things, 3 specific, carefully chosen, deeply researched plants, positioned in the right soil for their precise needs, watered on a schedule that reflects their specific requirements, monitored with the kind of close, knowledgeable attention that only comes from having a small enough number of things to pay genuine attention to. She knows them. She knows their rhythms. She knows their vulnerabilities. She knows the exact conditions under which they thrive and the exact warning signs that something is wrong. And her harvest is not 47 mediocre yields. Her harvest is 3 extraordinary ones. Her garden doesn't look as busy, but her table is full. Now, here is what I want you to understand about this image. The first gardener is not lazy. She is not unintelligent. She is not making an obvious mistake that any fool could see from the outside. She is doing what she was told to do. She is being diversified. She is following the conventional wisdom about how a responsible gardener manages risk. The problem is not her character. The problem is the model she's working from. The model that says more is safer, more is wiser. More is the mark of a serious investor who understands that any single thing can fail. What the model doesn't account for is the finite nature of attention. What it doesn't account for is the fact that understanding real, deep, actionable understanding of what you own is not scalable across 47 positions. At some point, you cross a line and you're no longer growing a garden. You're managing a collection of things you once thought about. Complexity is not productivity. Busyness is not the same as progress. And a portfolio full of things you half understand is not a safer portfolio than one full of things you truly know. It is a more anxious one. And anxiety, as we'll see, is one of the most expensive things a retail investor carries. Now, let me give you the second image. This one is more personal, and I want you to really place yourself inside it. I want you to imagine yourself 5 years from now. It's a quiet Sunday morning. You've made your coffee. You're sitting somewhere comfortable. You open your brokerage account, and the first version of this morning goes like this. You're looking at a list of 31 positions. You scroll through them. Some of them you remember buying clearly. You can still tell me the thesis, the reasoning, the moment you decided. Others you vaguely remember. You know you bought them, but the specific reason has gotten fuzzy with time, overwritten by other decisions, other news cycles, other moments of excitement or panic. A few of them you genuinely can't explain at all. They're just there, like furniture you forgot you owned. The account has grown a little, roughly in line with the broad market, maybe slightly below it. And you feel a specific kind of tiredness looking at it that is not physical tiredness. It is the tiredness of someone who has been working hard in a direction that wasn't quite right, who invested significant time and anxiety and energy and attention and got back roughly what the index would have given them for free, except with a great deal more stress. Now here is the second version of the same Sunday morning. You open the account, you see 3 positions, 3 companies, and you know each one the way you know a close friend. You know the business model at a level of genuine detail. You know the competitive landscape. You know the management team's track record and their stated strategy and whether their actions have matched their words over the years you've been watching. You know the balance sheet, not in a technical, jargon-heavy way, but in the way that matters. Do they have more coming in than going out? Do they have enough cushion to survive a bad year? Are they building something real? You know what would change your mind? You know exactly what warning signs would tell you the thesis is broken, as opposed to the temporary volatility that just tests your conviction without actually challenging it. And the account reflects something that casual, scattered diversification almost never produces. The compounding of genuine conviction over time, not the compounding of index returns, not the compounding of everyone else's average, the compounding of knowing something deeply enough to hold it through the hard parts and being rewarded for that holding with the kind of returns that patient conviction earns over years. Which Sunday morning are you building toward? I'm asking that genuinely, not rhetorically, because the choice of which morning you get 5 years from now is being made right now, today, in the decisions you make about how you allocate your finite attention alongside your finite capital. Now, let's get into the principles. Because the images are important, they work on you in ways that pure logic doesn't, but you also need the logic. You need to understand why this works, not just feel that it might. So let me walk you through the 4 core truths that I believe sit underneath this approach. And I want to go slowly through each one because I think each of them deserves more than a surface treatment. The first truth is this: conviction is a perishable resource, and you need to spend it wisely. I want to explain what I mean by conviction in this context, because it's not the same thing as confidence. Confidence is easy to manufacture. You can feel confident about something you barely understand if the headline was written well enough, or the analyst was persuasive enough, or you caught the stock on a good day and your brain has started building a story around that good day. Confidence is available on demand. It can be purchased cheaply, and it deteriorates just as quickly. Conviction is something different. Conviction is earned. It's the result of spending real time with a company reading their annual reports, not just the summary, but the actual documents where the real information lives. It's the result of understanding their competitors, understanding why some customers choose them and others don't, understanding what structural advantage they have that will still be true in 10 years. It's the result of sitting with uncertainty about a company for long enough to develop a genuine, tested opinion rather than just a surface-level reaction. That process takes time. It takes real effort. And it produces something genuinely valuable: the ability to hold a position through temporary adversity without losing your mind, because your understanding of the business is deep enough to distinguish between noise and signal. Now, here is what I want you to understand about conviction and why it matters that it's a finite resource. You cannot manufacture it at scale. You cannot develop genuine, deep, earned conviction about 40 companies simultaneously. The math doesn't work. The attention doesn't stretch that far. If you have 40 positions, you have a research obligation that would require a team of analysts to fulfill properly. And since you are not a team of analysts, since you are one person with a finite number of hours and a finite amount of cognitive energy, what you will actually have is a collection of positions supported by varying degrees of partial understanding. Some things you'll know fairly well. Most things you'll know superficially. A few things you'll barely know at all. And across that entire portfolio, the quality of your decisions will reflect the quality of your understanding, which is to say, it will be inconsistent at best and genuinely poor at worst. 3 positions changes this equation completely. 3 positions is a number that one careful, intelligent, genuinely motivated individual can actually understand at the depth required to make good decisions. Not easy decisions. There is no such thing as an easy decision in markets, but informed ones, grounded ones. Decisions made from real understanding rather than from the panic or excitement of the moment. And here is the paradox I want you to sit with. The investor who owns 3 things they genuinely understand will, in most cases and over most meaningful time periods, outperform the investor who owns 30 things they understand partially. Not because the math always favors concentration, it doesn't, and I'll address that honestly in a moment, but because the clarity that comes from deep understanding changes the quality of every single decision you make. The entries are more precise, the exits are more intentional, the holding through volatility is steadier. The ability to add to a position when it drops, which is where so much wealth is actually built, is far more available to the investor who knows why they own something than to the investor who bought it because a podcast sounded compelling. The second truth is this: understanding is the real risk management. The traditional model of risk management says spread your exposure. Own enough different things that no single failure can devastate you. And I want to be fair to this model because it contains a real insight: catastrophic single company failure, the company that commits fraud, or faces a regulatory wipeout, or simply goes to zero in a way nobody saw coming, is a real risk. And it is a risk that a concentrated portfolio faces more directly than a diversified one. I'm not going to pretend that concentration has no risks. It does. But here is what gets left out of the traditional diversification argument, and it is a significant omission. The investor who deeply understands what they own will see warning signs earlier, respond to them more rationally, and hold through temporary volatility with more stability than the investor who owns the same company at 3% of a 40 stock portfolio and checks it once a quarter. Understanding is not just intellectually useful. Understanding is structurally protective in ways that the diversification model doesn't even try to measure. Think about what it means to truly know a company. It means you know their competitive moat, the specific structural reason that customers keep choosing them over alternatives. It means you know their management quality, not just whether you like the CEO's public persona, but whether their capital allocation decisions over the past 5 to 10 years show genuine skill and integrity. It means you know their balance sheet in a real, functional way, whether the company is generating more cash than it spends, whether the debt levels are manageable across different economic environments, whether there is genuine cushion for an unexpected bad year. And it means you know their industry position, where they sit relative to competitors, what the structural tailwinds and headwinds look like, whether the business model is getting stronger or weaker over time. The investor who knows all of this about a company is not just better positioned to evaluate new information as it arrives. They are psychologically sturdier in ways that directly protect their capital. When the stock drops 20% on a disappointing quarterly report, they can ask, did the thesis break, or did the market overreact to short-term noise? And because they actually understand the business, they can answer that question with real information rather than with fear. The investor who owns that same company at 3% of a 40 stock portfolio doesn't have that resource available. They don't know the company well enough to distinguish signal from noise. And so they will often do the worst possible thing at the worst possible moment, sell into the fear at the bottom, because they don't have the understanding required to hold through it. Diversification protects you from things you don't know. Understanding protects you from things you do know but might react to badly. And of those two categories of risk, the second is where most retail investors actually lose money. Not in catastrophic single company failures, those are real but rare. In the steady, grinding, emotionally driven series of buy high, sell low decisions that happen when you don't understand what you own deeply enough to stay rational when it gets hard. The third truth is something I want to be precise about, because I think it's easily misunderstood. When I say 3 stocks, I am not saying that 3 is a magic number. I am not claiming some mystical property of the number 3 that makes portfolios work. What I am saying is that 3 represents a standard of understanding. It represents the question, how many companies can you genuinely know, not just have an opinion about, not just have researched superficially, but truly understand at the level required to hold through a 30% drawdown without losing your conviction or your rationality? For most self-directed retail investors, if they are honest with themselves, that number is somewhere between 2 and 5. For some particularly focused and experienced investors, it might stretch to 7 or 8. For most people, most of the time, 3 to 5 is the honest answer. 3 is not a ceiling. It is a floor of seriousness. It is the question, do I know this company well enough that I could explain it without notes to a skeptical, intelligent person at the worst possible moment when the stock is down 30%, when the market is in turmoil, when everyone is selling and everything feels uncertain, and still make a compelling case for why the thesis is intact? If you can do that for 3 companies, those 3 deserve the vast majority of your attention and your capital. If you can do it for 5, wonderful, you have 5 core positions, but the number should be determined by your honest assessment of your own depth of understanding, not by someone else's idea of what a properly diversified portfolio looks like. The standard is understanding. The number follows from that standard, not the other way around. And here is the contradiction worth sitting with, the one that I think is genuinely important to hold in your mind. Even though it is uncomfortable, a portfolio built around 3 companies you truly understand is simultaneously more concentrated and less risky than a portfolio built around 30 companies you have researched superficially. I know that sounds wrong. I know it violates the intuition you have built up over years of receiving conventional diversification advice. But I believe it is true, and I believe the reason it is true is that the risk that actually destroys most retail investors' wealth is not the risk of single company failure. It is the risk of emotionally driven decisions made in the absence of genuine understanding. And concentration, paradoxically, protects against that risk in a way that broad diversification simply cannot. The fourth truth is one that I find almost nobody in the financial education space talks about, and I think that's a significant gap. It's this. There is a psychological architecture to owning a concentrated portfolio, and that architecture matters enormously. It changes the emotional experience of investing in ways that have direct, measurable consequences for your results. Let me describe the emotional experience of owning 30 positions during a market correction. The market drops 10% in a week. Everything is moving. Red everywhere. Your portfolio is showing losses across nearly every line item, but the losses are different sizes, affecting different sectors, with different stories behind each one. You don't know which signals matter. You don't know which drops are buying opportunities and which ones are the early stages of something more serious. You're checking everything, reading everything, trying to process 40 different streams of information simultaneously. And what this produces is not informed decision making. What this produces is overwhelm. And overwhelm produces one of two things: paralysis, where you do nothing because you can't figure out what to do, or reactive action, where you make decisions based on feeling rather than understanding. Neither of those produces good outcomes. Now, let me describe the emotional experience of owning 3 deeply understood positions during the same correction. The market drops 10%, your 3 positions are down, you feel it. I'm not going to pretend concentration makes losses emotionally painless. You feel the weight of it more directly when it's 3 positions rather than 30. But here is what's different. You know what to do with this information. You know each of these businesses well enough to evaluate whether the drop is a reflection of something real changing in the business or whether it's the market being irrational in the short term, which markets do constantly and predictably. You can ask the right questions. Is the competitive moat still intact? Is management still executing? Are the fundamentals of the business still pointing in the right direction? And because you can answer those questions with real information, because you have done the work, the drop becomes something you can evaluate rather than something you have to survive. The clarity doesn't eliminate the discomfort, but it transforms it from chaos into a decision with real information behind it. Counterintuitively, and this is the thing I most want you to understand about the psychology of concentration, owning fewer things you truly know creates less anxiety than owning many things you partially know. Not more anxiety, less. Because clarity, even when the news is difficult, is always less frightening than confusion. The investor with 3 deep positions in a bad month is in a fundamentally different psychological state than the investor with 30 shallow positions in the same bad month. One of them has information to work with, the other has noise to survive. So let's get practical, because I never want to leave you in the world of ideas without also leaving you with something you can use in your actual life. Something you can pick up and carry into the real decisions you'll be making this week and next month and over the coming years. Here is the first thing I want to give you, and I'm calling it the conviction audit. I want you to go through every position you currently hold and write, for each one, a single paragraph explaining your thesis. Not a headline, not a ticker symbol with a price target, a paragraph. Why do I own this? What does this company do that is genuinely valuable and genuinely defensible in a competitive landscape? What would have to be true in 3 to 5 years for this investment to have been a good decision? And what specific thing, what concrete, observable development would tell me that the thesis has broken and I should exit? If you cannot write that paragraph in 10 minutes without looking anything up, you don't have a conviction position. You have a hope position. You have something you own because it felt like the right idea at some point, but you haven't done the work that turns an idea into a genuine investment thesis. And hope positions, no matter how many of them you accumulate, do not compound. They drift, they react to whatever the market is doing. They are the portfolio equivalent of the first gardener's 47 species present, named, and fundamentally unmanaged. After you've done this audit, look at what you've written. Not critically, not harshly, but honestly. Which 2 or 3 of these paragraphs have real depth behind them? Which ones could you expand into a full-page argument that would hold up under real scrutiny? Those are your candidates for a core portfolio. Everything else, everything you couldn't write a paragraph about without looking it up, is a candidate for simplification. Not necessarily immediate elimination, but honest reassessment. Is this here because I understand it, or because it felt safe to own? The second thing I want to give you is what I call the drawdown test, and it is specifically designed to reveal the difference between intellectual conviction and real conviction, because those two things are not the same, and the difference between them matters enormously in practice. Before you commit any company to your core portfolio, before you make it one of your 3, I want you to run it through this test. Close your eyes and imagine that the position drops 40% over the next 6 months. Not because the company failed, not because the thesis broke. The company is executing well. Management is doing what they said they would do. The competitive position is intact, the fundamentals are fine, but the market is being irrational, which, again, the market does constantly and without apology. And the price has dropped 40% simply because of macro fear or sector rotation or whatever story the market is telling itself this quarter. In that scenario, what do? If your honest answer is add to the position because the thesis is intact, because the business is still worth what you believe it's worth, because this is simply the market giving you a better price for something you already want to own, then you have real conviction. You have the kind of psychological foundation that can support a core position. If your honest answer is hold uncomfortably, white-knuckling it, hoping it comes back, then you have partial conviction. Enough to not sell immediately, but not enough to act with confidence. And partial conviction is worth understanding because it tells you that you need to do more research before this becomes a core position, or that the position size should be smaller so the drawdown is more psychologically manageable. And if your honest answer is sell, not because the thesis broke, but because a 40% drop would simply feel unbearable, then you don't yet have the conviction this approach requires for a core position. That is not a judgment. That is useful information. It tells you either that you need to spend more time with this company before allocating significantly to it, or that it belongs at a smaller allocation where the drawdown would fall within the range of what you can hold without losing your rationality. The drawdown test is not designed to weed out good companies. It is designed to reveal the honest relationship between your actual understanding and your actual emotional capacity. And that relationship, managed honestly, is the foundation of a portfolio you can hold with genuine stability rather than constant anxiety. The third thing is a simple operational constraint that I think is more powerful than it sounds, and I call it the one in, one out rule. It works like this. You commit to a portfolio limit, whatever your honest number is, 3, 4, 5, and you commit that you will not add a new core position without either closing an existing one or consciously deciding to expand your number with full awareness of what that expansion will cost you in terms of attention and depth. The purpose of this constraint is to force the comparison that most investors never make. Before you can add the new idea, you have to ask, do I understand this opportunity better than what I already hold? Is the thesis stronger? Is the timing more compelling? Is the risk-reward more attractive? You have to make an active choice, not a passive accumulation. And that single requirement will eliminate the vast majority of impulse additions from your portfolio. The newsletter tip that sounded smart at 10 in the morning, the podcast guest's recommendation that felt urgent in the moment, the fear of missing out purchase at the top of a move that you made because everyone else seemed to be buying and you didn't want to be the one person who missed it. The one in, one out rule doesn't prevent you from evolving your portfolio. Markets change, company situations change, better opportunities emerge, and your existing positions may reach full valuation and deserve to be exited. The rule allows for all of that. What it prevents is the slow, invisible dilution of a concentrated, high-conviction portfolio into a scattered, partial conviction one, which is how most disciplined investors eventually become undisciplined ones. Not in a dramatic moment of failure, but through the accumulation of small, seemingly reasonable exceptions that each made sense individually and collectively destroyed the clarity of the whole. Here is where I want to bring everything together, because I think the journey of this conversation has moved through several layers, and I want to honor that by pulling them into one clear picture before I leave you with it. We started with a disruption, the idea that more doesn't mean safer, that complexity is not competence. That diversification, taken to its logical extreme in the way most retail investors practice it, becomes something closer to anxiety management than actual wealth building. We looked at two gardeners, and I hope that image is still with you, the busy garden and the productive one. The difference between them is not the gardener's intelligence or effort or desire, it is the model they're working from. We looked at two Sunday mornings 5 years from now. And the difference between those two mornings, the 31 position drift and the 3 position clarity, is not determined by some future decision you haven't made yet. It is being determined right now in the current shape of your portfolio and the current depth of your understanding of what's in it. We talked about conviction as a finite resource that needs to be concentrated to be powerful. We talked about understanding as the real risk management, the thing that lets you stay rational in volatility when everyone else is making emotional decisions. We talked about 3 not as a magic number, but as a standard of seriousness, a floor of depth, a question you have to be able to answer before something earns the right to a meaningful place in your financial future. And we talked about the psychological architecture of clarity, the counterintuitive truth that owning fewer things you truly know creates less anxiety than owning many things you partially know. That the investor with 3 deep positions in a bad market is in a fundamentally different emotional state than the investor with 30 shallow ones. That clarity, even when the news is hard, is always less frightening than confusion. You don't need more positions. You need more understanding. You don't need a bigger watch list. You need a clearer mind. Wealth is not built by owning everything. It's built by knowing something truly, deeply, honestly, knowing it and having the courage to act on that knowledge and then hold it through the moments when the market tests whether you really meant it. You're not underinvested. You've just been overcomplicated. And there is an enormous difference between those two things. One is a problem of capital. The other is a problem of clarity. And clarity is always within reach. Simplify, clarify, and then hold. Those 3 words, practiced consistently across years, will do more for your financial future than any system, any newsletter, any trading strategy that promises to outsmart a market that has been humbling overconfident investors for as long as markets have existed. If something in this conversation landed for you, if the garden image clicked, if the future self morning made something real, if one of the principles gave language to something you've been feeling but couldn't quite articulate, I want to hear about it. Leave it in the comments. Tell me where it connected. What idea, what moment, what sentence? Not because I'm collecting compliments, but because naming the thing that shifted is how you begin to make it permanent. It's how an insight becomes a practice. It's how a video you watched on a Tuesday afternoon starts showing up in your decisions on a Thursday morning when the market opens and the noise begins. If this felt worth your time, a like takes 2 seconds, and it means something real. It helps this reach the people who are ready for it. Not people looking for a hot tip or a quick system. People who are ready to do the real work. The internal work alongside the analytical work. And if you want to keep building this foundation, the clarity, the conviction, the psychological architecture that makes any portfolio strategy actually function the way it's supposed to subscribe. Because that's what I'm here to build with you. One honest conversation at a time. One layer of understanding at a time. 3 stocks. Real understanding, real wealth. The path is simpler than you've been told. It just requires something more valuable than information. It requires honesty about what you know, about what you don't, about what kind of investor you actually want to be. Let's build it.